Hi everyone! There is now lots of speculation about the Fed's further steps on monetary tightening. In our previous video reviews, we have already discussed the market reaction to the haughty statements of some Fed officials. Now analysts are assessing the possibility of more aggressive rate hike, relying more on facts rather than emotions. After the Fed debunked rumors about a 100 basis point rate hike in July, risk sentiment returned to markets. It also improved considerably following the release of the University of Michigan Consumer Sentiment Index. It rose to 51.5 from 49.9 in July, while long-term inflation expectations, on the contrary, fell to 2.8% from 3.1%. Although the report was unveiled last Friday, it still boosts risk sentiment. However, analysts Alvin and Victor Young at UOB Group envisage a slightly different scenario. They believe that inflation has not peaked yet and its rise will continue in the third quarter. At the same time, inflationary pressure is expanding to the new components of the CPI index, which is rather worrying. For example, used cars are getting more expensive. Analysts note this is one of the indicators that should begin to decline immediately if inflationary pressure is weakening. On Wall Street, bulls are now in control. The second quarter earnings season is in full swing, whereas the FOMC meeting is scheduled for the next week. So the speculation about a 100 basis point rate hike that encouraged the dollar bulls last week has subsided. As a result, the US dollar index has already lost 0.6%. During the Asian session, it was consolidating in the sideways range of 106.55–107.63. After a two-day fall versus its main rivals, the index approached multi-day lows, stabilized at 106.72. Nevertheless, the US dollar is still trading near its 20-year high. While its price is passing above the 5-month level of 103.30, the short-term forecast for the greenback will remain bullish. However, traders are now closing long position on the greenback as it is shifting from the overbought zone. In the near future, its price may continue to decline. A decrease in the US dollar impacted the trajectory of the yen. After last Friday's surge to a high of 139.39, the yen is gaining momentum this week. It also keeps its appeal as a safe haven currency. However, the main reason for its growth is the weakening of the US dollar. Today, the yen is trading in the range of 137.59–138.40. In the Asian session, the dollar-yen pair was hovering at 137.72. From April to June, the pair has increased by more than 17%. In July, the rebound was only about 2%. The Bank of Japan maintains its dovish stance on monetary policy. The next meeting is scheduled for this Thursday. The regulator will almost certainly leave the key rate unchanged. Besides, the board has repeatedly voiced its reluctance to change the cash rate. The recent victory of the ruling LDP party in the elections gives the Prime Minister and the board governor full mandate to maintain the current monetary policy. The dollar-yen pair is highly likely to edge higher to the psychologically important level of 130. If so, it will open the way to 147.65, a high of August 1998. The RBA also remains consistent with its hawkish stance. The meeting minutes have been published today, revealing that the RBA considers the current key rate significantly lower than the neutral level. If the regulator wants to push inflation to the target level, it will need to hike the benchmark rate even more. This month, the RBA has already raised the cash rate by 0.5%. The level of interest rates was still very low for an economy with a tight labor market and facing a period of high inflation, the minister stated. At the same time, the regulator noted that the household savings reached about 260 billion Australian dollars. Australia's weekly consumer confidence index published today rose to 81.8 from 81.6. The Aussie went up amid the RBA's hawkish rhetoric and strong economic reports. In addition, China may allow homeowners to temporarily hold mortgage payments and provide financial support for the completion of existing construction projects. However, the Aussie is losing momentum due to falling oil prices and weakening risk sentiment. What's more, the widening rate gap between the RBA and the Fed is also a negative factor for the Australian dollar. The Fed meeting will be held next week, and the Reserve Bank of Australia will announce its key rate decision in early August. So an upward movement of the Aussie may be short-lived. Today, the Australian and American dollar pair is growing in the range of 0.6803, 0.6899. After the pair rose to a weekly high of 0.6853 on Monday from a two-decade low of 0.6682, it is now trading at 0.6890. So central banks worldwide are raising their key rates in order to move from a soft monetary policy adopted during the pandemic. They want to rein in galloping inflation and boost the economy. Time will show how fruitful their attempts will be. Subscribe to our channel and keep your finger on the pulse. See you!